Hey, welcome everybody to the 40 Finance channel. It's been a tough few weeks actually, here in September as the stock market has melted down, but I'm here to be the one or two people in the entire world to bring you some good news about stocks, even while we're in the midst of this bear market sentiment, cycle, crash, whatever you want to call it. We know that the news has been very negative lately, and at least most people in the media suggest that the negativity will continue for some time. So with that in mind, knowing that the negatives are well covered across the media, I thought that I'd come in and just give you maybe 5 reasons to believe. Maybe you don't believe, and that's okay too, but this is just another side of the coin when you're looking at stocks and thinking about the future. All right, so the first thing I want to talk about is the concept, let me get my notes here, is the concept of what good companies do in these times. And so you got to sort of throw away the economy for a second and talk about what individual companies do, at least the good ones, when these type of cycles hit, whether it's inflation, interest rates, consumer spending, you name it. The best run companies, we'll just assume the best run companies are mostly in the S&P 500. They change their business direction, okay? They change all the stuff that they do in anticipation for slowing trends. And if you do this correctly as a business owner, you can survive, if not excel to some degree, despite what's going on in the world around you. So I'm going to give you a few examples, and I'm going to start with Google, because I think that Google, at least in the headlines that I'm following, is preparing very, very well for what may be a slowdown. And I'm going to call out some very specifics. First of all, here's your one-year chart on Google, right? So you're $145, split adjusted, 145 back in September of last year, and now you're down to 102. All right, so Google, and I covered this in my last video, you can make a strong argument that Google's a deal right now, okay? Everybody has their own metrics, but we looked at 5-year perspectives, and most of their key metrics are coming in lower than we've seen over the past 5 years. So with Google, though, behind the scenes, so behind the guidance and behind the projections of sales and revenue, they are doing things to make sure that those numbers, when they report on a quarterly basis, those numbers, particularly EPS and profits, are being preserved, okay, preserved. So let's take a look at one of those examples. And what you're seeing with Google here, Google cancels next version of Pixelbook, dissolves computer hardware team. So this, the Pixelbook, if you've never heard of it, it's probably because it didn't sell super well. And this is September 12th, by the way. And so what Google is doing is just shutting the whole thing down. Why spend the money on producing this, not only from an HR level, and employees, but if it's going to go to the market and not sell and the margins aren't good, then why screw around with it? And what I thought was interesting, a news outlet noted that the new version of Pixelbook was far along in the development and was expected to debut next year. The Verge added that the new Pixelbook was dropped as a result of Google's cost-cutting measures. Okay, so the members of the team were not laid off and were transferred to other parts of the company, but this Pixelbook looks like it's seen its last day. We'll have to see if they ever bring it back up, but this is a good example of something that I'm just going to assume Google has spent millions and millions of dollars on for this new version of Pixelbook, and they're just going to cut their losses right straight ahead. No more spending money on this particular idea or this particular development. We're just going to leave the cash in the bank, cut the product, move on to the next thing, or perhaps more importantly, focus on what's working instead of trying to come up with, reinventing the wheels, so to speak. All right, so that's number one at Google. What else do we have here? Google issues cutbacks in experimental project group. So somewhat similar to Pixelbook, but totally different in the sense that Google has sort of a startup incubator, right? The company notified some teams at Area 120, its new project incubator, that their projects were being reorganized or canceled, and affected workers will need to look for new roles at Google. Up to half of the teams may have been affected, according to the report. Those cuts are being aimed in the direction of refocusing Area 120 on top priority artificial intelligence. So there's a couple good bits in there. First is obviously the cuts and the money saving, which is good news if you are a stockholder of Google, because they've obviously identified these areas as places that are not going to make a lot of money, certainly in the short term. But they are preserving the ones that show the most promise. And then you see this line focusing on top priority artificial intelligence. That's even more interesting because you would figure in the long term that the artificial intelligence would lower some of their needs for human employees. That's speculation on my part. So that's another headline. When I think about Google, I think they are making appropriate actions to move on, or to preserve profitability during this time. Next up, Google to restrict travel to business critical needs. When you're a huge corporation like this, whether you're Google or Procter & Gamble, there's a lot of expenses associated with business travel, and you saw the headline there. They have told a number of senior managers to restrict travel to business critical trips. The information reports another indicator of the company's expectations for managing a macroeconomic slowdown, macroeconomic slowdown. So this is yet another good thing that doesn't really impact where Google stands in the technology hierarchy of the world, right? I don't really care as a stockholder through QQQ, but I don't care if they're traveling to Europe and whatever and meeting in person. If you told me, I just want to make sure that your EPS continues on into positive growth, then yes, go ahead and do whatever you have to do, right? And that's exactly what's happening right here. Okay, what do we got next? So I'm going to close that. The next one that's up here, and this is not Google specific, but it's another reason to keep an eye on your stocks, particularly if you have small cap stocks that may be able to be acquired, okay? Because what's going to happen is the very rich companies like Google, who have a ton of cash in the bank, they're going to be looking out for these startups and these acquisitions that did not have enough cash in the bank, or as we'll likely hear in the news, they blew all their cash. There's an opportunity to add some good companies to, portfolio of larger corporations. So this can be good on two levels, right? This can be good if you own the small cap that gets acquired, right? Because it's usually for a price that's higher than their current stock offering. And then if you're a long-term holder of a stock like Google or Microsoft, then depending on how strategic you see the move, they are getting these acquisitions. I mean, you compare it to 2021, they're probably buying these acquisitions for 30, 40 cents on the dollar of last year's valuation, and that's only going to go down. That's only going to go down as we continue on. And this is just in Seeking Alpha here. You can see what I did. I just typed in acquires, and you can see the dates, 10:04 a.m. Look how many we have just in this simple search with no filter. 9:33. Scroll down, let's just say 5 or 6 more. You're still on it. Yesterday at 5, we still had more acquiring things coming into here. Okay, so this is going to be big, and it's not necessarily that each particular headline here is, you know, a huge mover, but I'm just telling you, you're going to see a lot more of this as time goes on, and it can be good depending on how strategic of a move it is. So acquisitions are out there, cost cutting is out there. What else do I have on my list? Oh yes, didn't even talk yet about buybacks. All right, so let's think about buybacks, and we know a lot about how Apple does this, Google, Microsoft, but what you see in this time period when stocks are going down, and understanding that stocks, you know, generally speaking, go up over time, companies that are doing buybacks as a strategy to boost EPS and control shares, as long as they have the cash to do it, this is an excellent time to do it. All right, and you look at the buyback search, same as the other one on the acquisition, and you can see all the names that are coming in here. Okay, there's Marqeta, climbs 1.5% on a $100 million stock buyback. Choice Hotels raises buyback program. Johnson & Johnson, $5 billion stock buyback program. And then this is just this article here is actually just from an analyst on Seeking Alpha who says, you know, this is pure speculation. We could see $100 billion stock buyback in Google. So that's not going to help revenue numbers, right? So if your company is one that's based very much so on, you know, like a price to sales ratio, that's not going to help a ton. But if you're looking at EPS a lot, like I do, then these buybacks, they add pennies to the EPS that you can expect to see over time. And perhaps more importantly, for the long haul, 3 to 5 years, less shares on the market means that when things do turn around, each of your shares is more valuable, right? Now, a big company, J&J, for example, they have, you know, millions and millions of shares. It's not like this thing turns the ship around all at once. Most of these buyback programs are spread out over years, but it's good news. I think it's good news if your company has the cash on hand to make that purchase. I know, let's see if I can get some information on PayPal's buyback, because I know that is going on. Let's see if I can get this search to work for me. This is back in September 5, August 31. PayPal rises after B of A upgrades to buy on cost savings possible buyback. So this right here, this headline, and I haven't read this article, pretty much exemplifies what you can see a good company do in a bad macro environment, okay? So in this case, Bank of America just upgraded PayPal stock on August 31st. We know PayPal's had their struggles, but they, you know, this analyst firm likes what they're doing. They let's see if we can get a quote here. Jason Kupferberg upgraded payment company name to buy from neutral, citing expected cost savings and potential for share buybacks. We believe these initiatives are likely to be pushed for by activist Elliott Management, and we note PayPal's new CFO, Blake Jorgensen, has a track record of executing well on cost margin initiatives. But this, you know, the short version here, as alluded to in the headline, is stock analysts, people like me, who understand that year-over-year revenue may not grow, or it may grow at a very small percentage point, right? However, what you can see is these cost-cutting measures make a huge impact to the bottom line, all right? So keep that in mind. Number 4, let's see, what did I slowed, messed up my own notes. Number 4, this is about the concept of growth, okay? So there is a difference, a very obvious difference, but it gets overlooked. between slowing growth, okay, and no growth or negative comps. All right, so keeping this in mind is very important when you're looking at, sorry, I'm just switching over this thing, when you're thinking about your stock. So let's just take, let's just look at Google. And let's talk about growth. All right, so we saw what Google was doing, and obviously there's a lot of concerns. Will Google be flat from here? All right, what will the stock market do? How will it pull it down? But if you look at the projections for forward numbers, such as, let's just go down to sales. Let's see what the forward sales are. By the way, if you like these screens I'm showing you, Seeking Alpha, they're having a major sale. And my affiliate link is in the description. Sign up, support the channel. You get a free 7-day trial. You do have to put in your credit card. It doesn't charge for 7 days, so you have plenty of time to look at it. Again, that link for the sale is in the description. All right, let's look for revenue. Why am I not seeing it? Should be, okay, revenue growth forward. Okay, it was right at the top. All right, revenue growth forward. All right, 21% is projected. So let's just say that that's wrong. All right, let's just say it comes in at 15%. Last year, they booked 26.27%. And this year, let's just say that it falls to 15%. All right, guys, that is still growth. That is not negative sentiment. That is not a bad thing if you're a company. You're still proceeding on your goals, albeit not as quickly as in the past. But it's a fine line the way people look at things, because what will happen is these earnings reports will come out, and the first thing that some headline writers are going to say is, oh, Google only grew 15% this year. Last year they grew 26%. The economy's terrible. They're never going to make it. And that's just simply not true. We had explosive growth for 2 years, right? For all the reasons we already know. And now here we are at a projected 21%. I'm shaving points off of that and bringing it to 15 just to pick a number. And it's still good news. It's still good news. What you want to be worried about is situations where this revenue growth is flat, or even worse than that, is negative, obviously. So some companies are going to have negative growth. They are going to move backwards. 1 year, say they made $5 billion in 2021 as an example, and then this coming year or the end of this year, they're going to make 4.8. That is negative, all right? That is bad. But I will sit on the fence of declining growth because it's still positive, right? And you start getting into EPS, look at this. This EPS diluted growth looking forward, plus 27% projected. Last year was 16.6%. So you're growing more profitability, not as much in the sales category, but more profitability. It's a pretty good place to be if you're running a lemonade stand, right? Or a food truck, or, bring some of this stuff down to the most basic level. And if you had a food truck and you had more sales this year, plus 10%, 15%, you're going to say, hey, I didn't grow as much as last year, but I can tell you as a business, if you're growing, you're generally doing the job correctly, right? So there's that one. All right, and the last of the 5 reasons that I have is pretty simple, and that is that if you're in this game for the long term, and you've seen zillions of charts like this, the stock market goes up more than it goes down on almost every single type of cycle that you can possibly imagine. Okay, so this is broken out. Just to give them some credit, this is from a place called Crestmont Research, and it is not brand new. It only goes through 2021. but they break out up days versus down days on the stock market, which up days versus down days is different than total gain, right? It's a percentage of days, whether they were up 0.1% or 0.3%. So it's a different way to look at it. But just on the straight days, and hopefully you can see some of this, but up days versus down days in the 70s as a whole, 51% to 48%. 80s, 53 to 47, 90s, 53 to 46, 2000s, 52 to 47, 2010s, 55 basically to 45, and 2020s, it's obviously been even better, 57 to 43. In a secular bear market, as they're defining it, up days, 51%, down days, 49%. During the bullish period, which they defined as 83 through 99, 54% up, 46% down. Then you go down here into, recent years, I get it. Some people are going to argue about recent years, which I think is fair because we've had so much good news. But look at the decades, right? And that was represented up higher. But you don't have to be a genius to see that at least on a daily misery index of stocks up and down, you're going to have more good days than bad. Maybe you're going to hit years where that number doesn't come in. We're probably pretty close on this year. But over time, you're going to be fine. And if you need further evidence, here's your S&P 500. And, I just pressed max here on Seeking Alpha for the chart. I feel like the S&P has been around longer than 1992, but we'll take it for what this chart is displaying. 1992, if you bought in at $402, okay, in 2022, which would have been roughly 10 years if I can get there, you would have almost doubled, 908, something like that. Then if you go to 2012, which is another give or take 10 years, and you would have made it to 1,400 if you lasted for 20 years. And then up here today, you're at 3,800. All right, but which direction is this moving? And there's so many versions of this tale in stock market lore, right? Like time in the market is better than timing the market, blah, 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 blah. Most of you have heard these quotes. Good companies that avoid bankruptcy, cataclysmic failure, things like that, they're going to follow this trend line, okay? So don't be too nervous about which way things are going here over the next couple months, 3 months, maybe 6 months. Don't be too nervous. If you have good companies, if you have good stocks that are continuing to grow, make adjustments to this market period, you're going to be just fine. So that's what I wanted to come on here today, share some good news. And, hopefully you're using this opportunity. Let's just pretend if you had Johnson & Johnson. We looked at Johnson & Johnson for a second. Hopefully you're using this opportunity, if J&J is even down, to buy more and lower your cost basis. And buy more doesn't have to be, it doesn't have to be buy all of it. It doesn't have to be deplete your savings and buy all of it. I'm going to sneeze here. Bless me. So here's your 5-year, right? Here's your 10-year on J&J. You don't have to go all in, but if you purchase, where's a peak? A recent peak is 160, 179-ish. Add a share at 162. You got $5 million worth of buybacks coming, and at least on this 10-year chart, things look like they've been pretty well managed. So just blow off some of these things that you're reading. Let's check out our negativity on CNBC today as I wrap this up. Dow drops 300 points as traders fret over FedEx warning. Wall Street heads for big weekly loss. All right? So you see the pain and the misery. That's what they're selling here today. Unless you are a day trader or a short-term investor, very few of these things matter right now. Stick to your guns. What have you invested in right now that you could possibly average down? Save cash. I mean, none of this is brain surgery. So I get a lot of people who comment. I think there was just one this week. They comment on the TQ's article, which is easy to pick on, or my videos where I invest in that, and they're like, "This is the worst call of the year." And their assumption is when I published that first video that I was going to pepper in some TQs just for fun. I've been writing it down. Their assumption is, oh, you came out in January, February, whenever the video was that they're commenting on. You came out and told people, and I don't tell people to do anything. I share what I do. You told people to buy TQs in February, January. That's the worst call of the year. Couldn't be further from what actually happened, which is I bought 2 shares. You could have put the same thing up there for J&J, for Microsoft. You buy 2 shares, see where it goes, go down, bought a couple more, go down, bought a couple more. And yes, I'm behind on my Qs and Ts, but it's not at the same rate that the whole year is down. So some people are they don't think about spreading out their purchases, and they don't think about where the future can go if they can just survive these dark periods. And if you have a good company, if you're owning good companies, innovation, cost-cutting measures, all those things will continue to accelerate. So, great stock vortex. You are the only commenter today. Hopefully you enjoyed it. You said Google, CRM, Meta, Adobe, which is the best buy? That's a tough one. I think, honestly, is there a bad one in the bunch? But I know that I have that on my Q tracker. So let me see let's go with what other people say. Okay, let's see what their rating is. Right here. All right, so you said Google. Let's just go in order. Google, and this is Seeking Alpha Authors, Wall Street Analysts, and Seeking Alpha Quant Score. Okay, so you'll have to remember that because I don't. Oh, okay. This header does follow along. Google, 4.2, 4.6, 4.67. So it's basically a buy under all 3 of these categories, whether it was independent analysts, basically people like me, right? Wall Street analysts who get published on major websites, they're on TV, and then Quant Score is Seeking Alpha's algorithm. All right, so Google across those 3 areas, and the Quant Score is cool. Let me just say this. The Quant Score is cool if you're into market trends, because that's kind of how this one works. It takes a look at buying activity. It takes a look at more of the technical indicators and momentum things. Whereas, analysts could be looking long term. I certainly look a year out. So here we go. Google gets 3 positive scores. Then you said CRM. I think I'll do CRM in a second. It's not in the NASDAQ. Meta. We know Meta is in the NASDAQ. Their score's not as good as Google. If you take these sources, 3.85, 4.2, and 3.3. So what you're seeing there, Google had 3 buys. Meta has 2 buys and basically a hold or a no action is what the orange means. Then we're going to go Adobe. And Adobe, similar to Meta, 3.5, 4.2, 3.18. For theirs, let me type in CRM because it's not represented here. They're going to make me do this a little different. Okay, so the quant rating is a hold on CRM. Authors, 3.9. And then Wall Street's big, 4.5. So I would say, looking back on it, it's probably ranked in order because this one got a strong buy, CRM. I think it would go Google, CRM, Meta, and Adobe, some version of that. But, Vortex, a year, two, can you really be upset with any of those companies? I would say my personal opinion, I think Meta's a good buy for, probably 2 to 3 or 4 years. The only problem with Meta right now is it's just stuck in mud. It's so stuck in mud. So I would assume you'll need the most patience out of Meta, not because I think it's going to go to zero by any stretch of the imagination, but they have they have to turn things around a little bit. They need to get the news cycle going positive again. And it's hard for me to imagine that that's going to happen before the end of the year. My guess, I think their next big positive move will be in 2023, and hopefully that gets them building up positive momentum. But I wouldn't mind having a share of Meta right now, and I have plenty through the Qs. But to me, it feels like it's the one that's stuck in the mud the most. Hopefully that helps. All right, he's buying a little of each. She, I should say, buying a little of each. Google is largest position. I can't even imagine. Literally, I cannot imagine a world without Google. When you start to think about even the dumbest stuff, right? Gmail, Google Maps. Get search away for a second. I'm a big Google fanboy. I'm an Android user. We have Google Nest products at our house, which work spectacularly. I just can't imagine it. Obviously, consumers have choices in America, so it's hard to imagine a world without Apple as well, or Microsoft. But I mean, Google not existing or not growing, as more and more people get into the digital age, it's hard to fathom because they offer good things. If you want to wear a tinfoil hat and worry about your privacy, or maybe you're doing illegal things, okay, fine. You can't use Gmail, right? And you're mad, and maybe that's why you're mad about the privacy or what they know about your Gmail. I don't have anything to hide myself, so I love Gmail. I love using Google Docs, right? Sheets and all that stuff. I like all the tools that they provide, which, to be fair, many of them are free. YouTube, which we're on today, free entertainment. You don't have enough money to buy cable or get a streaming service, YouTube's free. I mean, it's so take your pick. I think the people who are anti-Google, anti-tracking, I would love to go into some of their houses and see which of the products they're using. And I guarantee you, as much as they rant on Twitter, they're probably on Gmail half their day. So that, it's a little bit tongue-in-cheek on statements like that. But all right, great stock, Vortex. You're my only commenter. You win the award today. I hope you're doing well. I hope your stocks rebound as quickly as possible. But in the meantime, keep trickling away. Put some money away. The U.S. dollar is strong. If you are going on international investments right now, if you're going to say, I want to invest in the strongest country right now from a dollar / futures perspective, it would be the U.S. dollar. Now, that doesn't help you here where things are expensive, but if the worst case scenario, you are an international traveler, or you are thinking about maybe I'll live in a different part of the world, or maybe you live in a different part of the world and you're looking for a hedge, the U.S. dollar is not a bad place to be right now. Catch bean, you can't spend it in the United States to take advantage of that. You have to get U.S. dollars and buy something somewhere else. But long story short, this storm will pass. Things will get back to normal. I'm not sure when, but I'm using it as an opportunity. Hope you guys are doing great. We will see you on the next video.